to ask questions after the management's opening remarks. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Naveen Agrawal, Head Institutional Equities at SKP Securities. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. On behalf of Somany Ceramics Limited and SKP Securities, it's my pleasure to welcome you to this financial result conference call. We have with us Mr. Abhishek Somany, MD and CEO, Mr. Srivastava Somany, Mr. Ameya Somany, Mr. Sailesh Raj Kedawat, CFO, and Mr. Kumar Sumit, Head Strategy and IR. We'll have the opening remarks from Mr. Somany, followed by a Q&A session. Thank you, and over to you, Abhishek ji.
Good afternoon, ladies and gentlemen. Thank you for coming on to our Q1FY25 conference call. So as you can see from our results, it's been a very tough quarter. There's been a muted demand, and it got further aggravated with the elections, extended elections across, and the extended heat. But it's been a flattish quarter. As far as sales volume is concerned, and also as far as value is concerned, the receivables, however, the balance sheet, however, has improved. The receivables went down by another 5 days. Average realization has also declined very little Q1Q. It's only about 3 rupees Q1Q. That generally is seen because in Q1 most of the non-value-added products get sold. So we've been able to maintain no serious discounting or anything like that. So on the flattish quarter, there was no pressure from our side to further improve that 10-20 crore rupees to sales. And therefore, we've been able to further bring down our receivables.
The realization has gone up Q1Q.
I think realization has gone up. I'm sorry, Q1Q. I'm mistaken. Capacity utilization obviously from Q4 has declined, but if you look at it from last year YOY, that's gone up to 81%. Last year YOY was 70%, and this year is 81%. Q4 being the best quarter, so that's always higher. So from that point of view, it's down from 89 to 81%. Operating margins, obviously, as far as tile industry is concerned, I've said that in the past, and I say it again, that most of our EBITDA comes through capacity utilization, and the minute capacity utilization is declined, we have a fall in EBITDA consequently, and so in PAT. But having said that, we've been able to maintain our EBITDA, although our sales have been down. Costs are up, obviously, because the increments have already been given, so that's factored in. That's an annualized increment for all the people. So from that particular head, the costs are up, but otherwise we've been able to mitigate the other cost increases by efficiencies and better management. So we've been able to maintain the operating margin at 8.5% versus 8.7% YOY. Gas prices have helped us. They've been largely stable during the quarter, and going forward also we believe that this would be largely stable. As far as the other capacity utilization is concerned, which is sanitary ware and faucets, sanitary ware ran at 96%. That is up from the previous levels. This is more towards, we're trying to push more and more towards value-added segments. And faucets has been at about 90%. But in faucets, I must remark that this 90% is on one shift, so we do have enough capacity built in if we had to run another shift. But historically, we've been running only one shift, so there's more than enough capacity built in case the market had to turn for the better. As far as our segment revenue is concerned, in Q1 FY25, ceramics was 35%. YOY it's up 1%. PVT was 28%. Ceramic was 35%. YOY is down 4%. PVT was 28%, which was flat. GVT is 37%, which YOY was 33%. So this has ceramics has been replaced by GVT. The brand spend is going to be maintained annualized between 2.75 to 3%. However, the brand spend in Q1 is generally lower, so it's at 2% in Q1. Our working capital days have also largely been maintained at approximately 13 days in Q1 as compared to 8 days in Q4. We are quite positive on this particular year. We have our Max plant up and ready. That's the only subsidiary which is still the newest, and it's at a capacity utilization of about 35-40%. We are seeing that is steadily increasing. So that's going to be the green shoot for next year, which will bring us value growth. And otherwise, this year we're still looking at a double-digit growth, looking at mostly driven by volumes. EBITDA margins, like I mentioned earlier, with the caveat of gas prices not spiking, we should be able to improve 1.5% EBITDA, basically on the riding on better capacity utilization and better product mix, and also a 10+% growth, so a double-digit growth over there. There has been few green shoots out of the budget. The investment of 10 lakh crores under the PMAY for the 10 million new houses should help the tile industry in future. Otherwise, all the new launches which have happened in the builder segment, in the private builder segment, which we've witnessed over the last 18 months, all that will come into play from the end of Q3 onwards. I would want to touch upon a little bit about exports. The exports have improved since the lows of January and February, where it had gone down to 1,350 crore rupee levels. It's come back to 1,650 to 1,700 crore rupee levels per month between April, May, and June. So this steadily is going up. This is also a very, very positive sign that when the freight rates are at record high, the exports have still come up from the 1,350 levels to 1,700 or 1,650 crore rupee levels. So this is something which will keep aiding the tile industry from India. So this is as far as the opening statements are concerned. I would now like to open the floor to any Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Keshav Vijayaratan Lahoti from HDFC Securities. Please go ahead.
Hi, thank you for the opportunity. So this quarter volume has been more like 1% degrowth, or possibly the industry leader have done a way good. Normally we see you and industry leader grow in line. So what is the take on that, and what is your volume growth guidance for this year, and what sort of margin you are looking?
So if you see the industry leader, there's been a 17 rupee decline in realization. Our decline has been very little. They have launched a particular kind of a new a line, which is a cheaper line. We hadn't done any such thing right now. So it has been a tough quarter. My degrowth from a volume perspective, from a value perspective, is just about 8-9 crore rupees. We didn't want to push the system. We didn't want to choke the system because we know we're getting into July and August, which are generally rainy months. So we stayed away from that. So our balance sheet is healthy, our dealers are healthy, my receivables are healthy. We're still looking at a double-digit growth, and I don't think there should be an issue with all our plants completely up and ready as far as we're concerned. So our DSO is down by 5 days, as you can see, and also our realization has been maintained.
We have been talking about pickup in tiles demand. Has anything played out so far? How has been the July month?
So July has also been a tough month. After the budget, it's been a tough month. But it's been better than May and June is what I can say. But it has been a tough month. So it's not that it's a wow month, considering that we're done with the elections and done with that. But it's not a great month. But it's better. It's better than May and June.
Understood. Can you please give the fuel cost in Q1FY25 region wise?
Sure. So just give me a second. The three regions which you are talking about, there's the north region, the west, which is Morbi and our Ahmedabad plants, and also south. So Q1FY25, the Qatar plant is at 43 rupees. Last year was at 45, 46 rupees, same quarter. Morbi is at 45 rupees a standard cubic meter. Last year was at 43 rupees, so this is up 2 rupees. South is at 47 rupees, and last year it was at about 55 rupees.
Okay, got it. And the current prices?
I'm sorry?
Current prices are same? Current price level?
There's been no change in the prices I've given for last quarter. I mean, if there's a change, 50 paisa, 1 rupee plus or minus, but nothing, no significant change.
Okay, got it. Thank you.
Thank you.
Do consider that, I would like to mention that more and more of our spray dryers keep moving to biogas, and we're experimenting in cheaper and better biofuels. This is something which is new to us in the last 2 years, considering that for 50 years we've been running the plants on gas and partly on spray dryers on coal. So this is a whole new subject. We're keeping on experimenting on new fuels, new formulas to see how we can bring the cost. So that also comes into play here, not only gas. So do keep that in mind.
Yeah, sure.
Thank you. The next question is from the line of Pankaj Tibrewal from Ikigai Asset Managers. Please go ahead.
Good afternoon, Abhishek. Can you hear me?
Yes, absolutely.
Yeah. So one thing which we have done very well over the last few years is our discipline on working capital and hence the cash flow generation. Can you just take us through that this difficult
Sir, sorry to interrupt, but the volume for you has gone very low.
Can you hear me now?
Yes, this is better, sir. Please go ahead.
Yeah. So I'm just saying that in this quarter, when it was a difficult quarter in terms of volumes, how has been your cash flow discipline as you navigated this difficult quarter? Can you just take us through that part? And second, when we speak on the ground, Simpolo seems to be doing quite well. We saw the volume growth of Kajaria. Does that mean that we may have lost a bit of market share in this quarter, or probably it's not the case there? Some light on that. And from a 2-3 year perspective, how we should visualize the company in terms of size, scale, because some of the unlisted players are also getting very aggressive on the market share game. So these are the 3 questions. Thank you, Abhishek.
Thank you. So I will take the first one, which is one part I will take, and the rest of the part I will ask Shailesh and Sunit to pitch in. So as far as our cash flow is concerned, like you've seen, we've been able to maintain our average realization. We've been able to go down 5 days on DSO. The rest of the cash flow, which is the nitty-gritty of the cash flow, I would let Shailesh and Sunit pitch in, and then I'll come back for the next 2 questions. Go ahead.
Good afternoon, Pankajji. For our cash flow, if you see, we have done close to 50 crore of EBITDA this quarter. And there's some money which has gone into working capital. There's working capital days has gone up. It's around 25-30 crore has gone into working capital. We have been able to be net positive from operations. Maybe around 15-20 crore is what we have been able to make from operations, and we have not done any major capex. So we are net positive this quarter. There are no capex which have happened in this quarter. And we are looking forward, next 3 quarters, I think we are looking forward for a very positive cash flow. Because there are no major capex which are planned.
Okay.
I hope that answers part of the question. The second question is on the market share, which you have mentioned 2 players, namely Kajaria and Simpolo. So my response to that is that Simpolo is on a completely separate segment in which he is growing, both value and volume. We are nudging up in that particular segment, which is a large format tile. So if you see Simpolo, he probably would have a reasonable degrowth in the bottom end of the prism, but his top end of the prism, because he's been in this game for the last 5-6 years, he's being able to leverage that. But that is something which I have said in the past, that with our max plans which started in August and in third quarter and launched in December, we've been able to do a reasonable amount of sales there. I can take you offline small nitty-gritty numbers which I would not want to do on public forum. but I will give you the number as to how we've grown in the big style segment. So there's been no market share loss there. In fact, we gained market share as far as Somany is concerned because we sold a lot more of the big format, not as much as them. As far as Kajaria is concerned, I think the answer to that is that they have launched a new product line, which does not bear the name of Kajaria. There is a new brand which they've launched at the bottom end of the prism. That's driven a large part of the sales. So have I lost any market share Kajaria to Somany? No, I have not. So that is the answer for the market share perspectives between the two brands which you mentioned. The third question was how do we see the company 3 to 4 years down the line? I think, our bread and butter is going to be the middle end of the prism. We are further solidifying that particular product portfolio. We're doing a lot of balancing equipment within our plants to further improve our line balancing, which we've spoken in the past, to improve our ROC. So any capital employed which is not as well utilized or any capital employed which is vacant, we're doing some line balancing to make sure that how we can further fortify the bottom at the middle end of the prism. As far as the top end of the prism is where Simpolo is today probably the industry leader in that particular segment, and there are one or two other very, very niche brands. That is something which will take a year or two, where with our match plant, we are going to even penetrate that. But we're not getting super obsessed with that because the bread and butter segment is the middle end of the prism. So we're fortifying that, and these both put together, plus the sanitaryware and bath fitting, where we are again fortifying the sanitaryware and bath fitting segments. We're looking at many more SISs, many more showrooms, many more SIS means showroom and showroom, shop and shop, and also exclusive showrooms. So we're both of these segments put together, which is rather three segments: the middle end of the tile segment, the top end of the tile with the max plant, and sanitaryware bath fitting. We're looking at
Excuse me, sorry to interrupt.
I think we dropped.
The line for the management seems to have disconnected. Ladies and gentlemen, please stay with us while we reconnect with the management. Ladies and gentlemen, we thank you for your patience. We have now reconnected with the management. Over to you, gentlemen.
Yeah, sorry. I'll just repeat the last 10-20 seconds. So I was saying that we're at the top end of the prism driven by Max, fortifying the middle end of the tile segment, and the sanitaryware and bath fitting put together, we should be looking at a double-digit CAGR growth for the next 3 to 4 years. That is how I look at the company, Pankaj bhai, where we're further fortifying the middle end of the segment. And I would happy to get on an independent call with you to explain a little more about this.
Great. Thank you, Abhishek ji, and wish you all the best.
Thank you, Pankaj.
Thank you. The next question is from the line of Akash from UTI Mutual Fund. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes.
Yeah. Hi. Good afternoon, sir. Just wanted to ask, in tiles industry, I mean, do you believe that from H2 FY25 or let's say by FY26, certainly, I mean, there will be improvement in volume growth across the industry?
Yes, absolutely. Fueled by export, which is growing, and also fueled by all the new apartments and residential colonies which have been announced. They will all start taking up tiles because currently all of them are in the construction mode. So the next 3 to 4 years, great for the tile industry, and volumes will improve on both ends.
Sure. And sir, if we assume this that let's say by FY26 things should certainly improve, then is there a possibility of we delivering close to 15% volume growth, or it can be more than that, or it would be a stretch? I mean, any rough cut?
I think what I can stick my neck out is of a double-digit growth, whether it will be 15 or 12 or 18, too early to say. So I would restrict myself to saying a double-digit growth.
Right. Sure. And sir, I mean, if you can briefly help us understand the key levers that can help you improve margins to say around 10-11% over next 2-3 years at least.
So, if you're looking at margins at 10 to 11%, that is something which we have guided for any which ways. And the only caveat there is gas pricing not spiking, and that doesn't seem to be. I think the three levers are, of course, growth between the very high single digits to decent double-digit growth, which basically culminates. I'm not saying that we will do high digits, but I'm just giving you the levers. We at a double-digit growth, what happens is that your capacity utilization becomes much better. So capacity utilization is a big lever for EBITDA, and also, like I mentioned in the earlier question, fortifying the middle end and the top end of the prism, which is more for value addition. So these are the two big levers for us to bring our EBITDA.
Sure, sir. And any thoughts around exporting styles? I mean, any thoughts around that segment of the market? Thank you.
So export is largely Morbi phenomena. As far as we are concerned, we are pushing as much as possible on export. But there are two issues. One is the Morbi guys give extended credits and open credits, which we are not willing to do. The second thing is there's a lot of Morbi players which are dampening the brand India because they're producing such pathetic quality for export and sending such pathetic quality abroad that it is dampening brand India. So I'm not saying all of Morbi is like that, but most of Morbi is like that. There are good people in Morbi who are also getting affected like we are in terms of export. But I think as and how the export keeps growing, we would also get a small share, extra share of that. And one thing I want to highlight here is when Somany talks of export, we do not include the SAARC countries in our export, unlike our competition. So for us, export, so for example, Nepal is not part of our export figures. That is something which I would like to point out, which has been pointed out to me by my finance colleagues, Sunit and Shailesh, because all other competition, I believe, in their figures, Nepal is counted as exports.
Right. Sure, sir. And we, as of now, are selling in Nepal also, right?
I'm sorry?
Sir, we are also selling in Nepal, right?
Of course.
Yes. So, thank you, sir. That's all.
Thank you. Ladies and gentlemen, in order that the management is able to address questions from all participants in the queue, we request you to please restrict your questions to 2 per participant. You may rejoin the queue for follow-up questions. We have the next question from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Just 2 questions. Sir, you indicated the launch of one of the competitors at the bottom end of the prism. Sir, can you qualify or give some color on what exactly this means? And
I don't understand the question. Can you just please repeat? It was a little not very clear.
Right. Sir, in your prior remark, you indicated the market leader, they launched a product at the bottom end of the prism. Can you provide some color over here? And would we have any plans to do something similar, given probably that part of the market is growing at a faster rate? How are you approaching this?
Yes, we are. We do have a product. We're going to strengthen that going forward, but I would not want to comment and put any light on their strategy. It would be better you ask them.
Okay, sure. That helps. So second is you indicated on biogas. What is the underlying economics over here as compared to the blended gas pricing, what you indicated? And how much incrementally the biogas can increase on a percentage kcal basis which can give incremental levers on the cost curve for us?
I think biogas can only be used in the spray dryer. So most of our spray dryers are now moving slowly and steadily to biogas. I think about 70% of our spray dryers have moved to biogas, and a little more is left. So I do not have the blended cost offhand, but I'll work that out and we can talk about it. But to answer your question, we cannot move our kilns to biogas. It's only the spray dryer which can move to biogas.
Sure. And what would be the costing for biogas?
Kilns can largely run on any kind of natural LNG or LPG or propane.
Right. And sir, what will be the biogas costing?
It is very open-ended because, we're using 4 or 5 kinds of biogases. So every one of them has a separate costing in terms of adjusted kilocalorific value. So it's better that we could do that separately on a call, and I can explain that to you because it would be a very long discussion.
Sure, sir. That sounds fine. Thank you so much. All the very best, sir. Thank you.
Thank you. We have the next question from the line of Madhur Rathi from Counter-Cyclical Investments. Please go ahead.
Thank you for the opportunity, sir. Sir, as you mentioned that our competitor grew because of realization decline. So, is there a situation where the competitor intensity is increasing and the competitor to gain volume is like reducing the prices, and we have guided that we will not decrease our prices. So, can we get an effect of this going forward for this year and maybe next year?
I don't think I want to highlight too much on pricing. Pricing has been reasonably stable. We are only trying to see how we can improve our realization going forward. This quarter has been a tough quarter. I didn't want to choke the system by pushing that extra 20-30 crore rupees in the market, because that's the delta between my degrowth of 1% to my growth of 2 to 3%. It's basically, at the end of the day, it's a 20-30 crore rupee delta. So we didn't want to choke the system by either discounting or putting a product in which is of a cheaper quality. So basically that's what we did. So it's not that prices, if I reduce prices, sales could have improved or anything like that. It has been a tough quarter. It's been a slow quarter across the industry. So, I could have done the sales, but then I would have had to repent that in July, where the July secondary sale would have happened. I think we're keeping a lot of watch on what is happening at the secondary sale and don't want to unnecessarily choke our dealers where receivables become an issue.
So we don't find it like the volume is, our volume targets, we are very well possible to achieve this for year, right?
Sorry?
So the double-digit volume target that we have for this year, it will be very much possible to achieve this for this year. Okay. So just a final question, sir. In Nepal, we and our Kajaria are like adding around 8-9 million of square meters of capacity in a 20 to 25 million market. So do we see this being a strain on our margin going forward, or because there will be a very huge inventory coming into that market?
I wouldn't want to comment on Nepal. We had a plant. We bought land there. We were almost going to put the plant there. We held it back because Nepal, the demand, which was estimating at 18 to 20 million square meters per year, has gone down to 11 to 12 million square meters. And we have capacity now by the end of the year of approximately 20 million there. So good luck to people who put their capacity there.
Okay. So the max plant that we have currently running at 35-40% utilization. So sir, what utilization can we expect our margins improving by the 11% that we did last year and a 1.5% increase over that? So will it be at 80% that we can achieve a 12-13% kind of margin maybe in this year, or as the max plant utilization improves?
Obviously, we're working towards bridging the gap between industry leader and us, so that goes without saying. So yeah, that's work in progress. Now, it's not only going to be the max plant. If it was so simple, then everybody could have put a max kind of plant. But I think it's a host of many things where realization improves. Your brand equity in the market, how you're penetrating, what you're showing, your distribution, your middle end of the prism, how that is getting fortified, the max plant, etc., etc. Capacity utilization. So one level improves EBITDA.
Thank you, sir, and all the best.
Thank you. The next question comes from the line of Sneha Talreja from Nuvama. Please go ahead.
Hi, good afternoon, sir, and thanks a lot for the opportunity. Just two questions from my end. I think firstly on your opening remarks, you mentioned that you are seeing green shoots, specifically coming from budget. What I actually wanted to understand is, are you seeing anything from the realistic uptake front? We have been hearing about a lot of launches, new execution from all the builders, but haven't seen that amount of pickup from the tile space. So when can we actually see that happening, or are you already seeing it happening? That's the first question.
No, I can't really get what you're saying other than the green shoot part of it, which you asked.
So basically, what I wanted to check with you is, you mentioned on the con call there are a lot of green shoots visible, especially from the budget front. What I wanted to check is, are you seeing any green shoots from the real estate demand front? We've been seeing all the launches happening, real estate players reporting good numbers, but we haven't seen that translating into demand for tiles. So that was the first question.
Yeah, I mentioned the green shoot from a very long-term perspective. Obviously, if he's announced, if the finance minister has announced 10 lakh crores for the PMAY, it is going to start culminating at some point of time. And the way the government is, we've seen in the past, when they announce something, they get after it, whether it was the Swachh Bharat or whatever it was. So as far as the other, the launches which have happened, is what I gathered in your question, the launches which have happened from the previous year, there is going to be an upsurge in demand for sure, because behind the wall is what got put, pipes, cement, steel, etc. I think in front of the wall, which is all the finishing items, tiles, sanitaryware, bath fitting, they're all waiting for that demand to come. And there are restrictions, etc., etc. These buildings will have to get completed. And there's a hell of a lot of buildings which have been announced and ready to be completed in the next 6 to 8 months. So I've been moving a lot in the market with projects, and everybody is saying that, all the demand is another 5 months away, 4 months away, 6 months away, 8 months away, stuff like that. So clearly, more than us, the entire tile industry has going to benefit from the real estate upsurge, which has happened after a good 10 years.
Understood, sir. That was helpful. Secondly, more on Morbi, given that there are 1,000 odd players and demand is weak at this point of time, both in domestic as well as in exports, is slightly on the muted side. What must be the utilization levels there, and what are those players doing? Are they shutting down plants or waiting for the pickup to happen, or are they cutting prices, credit base? What's really happening on the ground?
They're doing all of the above. I think they're not cutting pricing, but if you see, I get an SMS from Morbi, from traders who have, everybody's number, they all buy address books, but keep getting SMSs. So there's this new trend of something called a one-time sale. So they're taking advantage of this one-time sale when they get rid of certain amount of stocks. Saying in another way that, this price is only limited for this particular stock. But it's become rampant to get rid of their stock and get their working capital. Just in the morning, one of the Gujarati newspapers said that 200 units have shut down, and 150 units have shut down, and another 200 are up for shutting down. As far as capacity utilization is concerned, I've given to understand it's between 65 and 70% capacity utilization. So there's more than enough capacity available in Morbi. So they're doing, pretty much everything from tax evasion to doing this one-time sale to also shutting down plants interim. So considering that they generally, if you see, Sneha, in the past also, closer to the Janmashtami at times, they generally have a shutdown of a month and a half. So that's what's happening. The news agencies just pick it up and blow it out of proportion. But I think this 350, 400 units closing in Morbi at 65-75% capacity utilization is one thing, but the other thing is also around Janmashtami. They anyway close every year.
Understood. That was really helpful, sir. Thanks a lot, and all the very best.
Thank you.
Thank you. Ladies and gentlemen, we request you to please restrict your questions to 2 per participant. You may rejoin the queue for further questions. We have the next question from the line of Jyoti Gupta from Nirmal Bang. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. My question is on the production side. We've had a CU level of 81% in tiles, 96% in sanitary ware, 90% in faucets. Now, the demand in quarter 2 still remains weak, which I believe is weak. Do we see an inventory build-up, and do we also see that the utilization level is going down in quarter 2? Which means either the EBITDA or let's say the revenues are going to be flat, and of course it will impact the EBITDA. The second question is, when do you see the demand pick up happening in the third quarter? Is it after Diwali? Do you foresee it, or a little earlier than that?
So the major demand, of course, from the real estate and all will pick up H2 onwards, maybe quarter 4 onwards. But as far as they're concerned, it was a better month than May, June. August should be slightly better. September obviously will be better, much better than June. As far as capacity utilization is concerned, I do not think there will be a huge upturn in capacity utilization. As far as tile is concerned, sanitary ware and carpeting should be okay. Sanitary ware, there is a caveat that, sanitary ware generally goes down a little bit in capacity every year because of rains. That affects the sanitary ware production, the mold production across the country. It's nothing to do with us. So having said that, the rest of the production will be consumed. Bath fittings, no issue at all. Tiles would remain here or maybe improve a little bit. We have seen more than enough inventory for us to carry forward with a growth, so I don't think it will be a flat quarter for sure. Having July already grown a little bit.
Can I ask one more question?
Ma'am, I request you to please return to the queue if you have follow-up questions.
Okay.
Thank you.
Thank you.
The next question is from the line of Udit Gajiwala from Y Securities. Please go ahead.
Yeah, thank you for taking my question, sir. So one is that you are quite upbeat on the double-digit growth this year, but that entails your 9-month ask rate to go into 14 to 15% kind of a growth. And with July, you just commented it is obviously not flat, but you are seeing some growth. So does that mean that H2 will be something very robust that you are envisaging right now?
Yeah, last year also H2 was robust, so we're looking at even a better H2. So yeah, we are reasonably confident of that.
Got it. And so the demand that you are seeing, could you specify? I mean, is it the metros or the tier 1, tier 2 where you are seeing the green shoots to happen?
Yeah, with generally metros are a project market. So if you see Bangalore, Hyderabad, Pune, Bombay, Delhi, they're mostly project markets where large developers buy tiles. The smaller towns is where the individual homes, so which is what we call IHBs. So I think it's a host of both. Earlier, if you take prior to 2024, which is last year, I think all of our growth was driven by retail and mostly IHBs. But now we are seeing a lot of traction even in the larger cities, where new launches have taken place and all the builders, the more disciplined builders have, launched so many apartments. So there's a lot of traction even in the larger cities. So it's a host of both.
Got it, sir. Thank you for answering, sir. All the best.
Thank you. The next question is from the line of Vinamra Hirawat from JM. Please go ahead.
Hi, sir. Am I audible?
Sir, you are audible. You may proceed.
So my question was on gross margins. I want to know, the reason for a big uptick in gross margins, excluding power, and why power was a higher percentage of sales this quarter compared to last year.
Yeah, I would let my CFO Anthony come into after this.
So our gross margin has gone up on YoY basis. It has gone up by 230 bits. However, since operating levers have not worked properly in this quarter and we are at a lower sales volume of almost 8-9 crore rupees, whereas overhead has gone up on YoY basis, largely attributable to employee costs because of annual increment. That's why EBITDA has come down. So if you talk about gross margin, it has gone up from 32.9% to 35.2%.
Yeah. So just want to know the reason for the increase in your gross margins without power.
The input costs are the primary reason. We have been continuously working on the cost improvements, and the stable gas price has also helped us to some extent. So these are two reasons primarily attributable to improvement in gross margin.
Okay, I just had a question on government projects. Government is obviously pushing infrastructure massively. Are we targeting any government project? Our competitor recently has dedicated a whole team into targeting government projects pan India. What is the growth we're seeing there, and are we targeting this segment aggressively?
Yeah, so government projects is something which has always been a focus area. About 11 to 12% of our revenue comes from there, and we beefed up our government projects further, specifically in South, because North is anyway very strong for us. We specifically beefed up the government projects team in the South.
Okay, that's it for me. Thank you.
Thank you. The next question is from the line of Utkarsh Nopani from BOB Caps. Please go ahead.
Yeah, hi, good afternoon, sir. So I just need few clarification. First, like we have mentioned over the call that our realization has actually improved on Q1Q basis in this June quarter, but our calculation indicates that the blended tiles realization has gone down by 1.3% in this June quarter. And like our realization has been under pressure for the past 3 quarters. So do you see that tiles industry pricing scenario is likely to remain weak till the time ocean freight rate comes back to the normal level?
So I'll let Zinit answer the specific question, the first one, but let me tell you, tile industry is the only industry in the building material segment that if you take a 10-year CAGR inflation and if you take a 10-year CAGR increase in price, tile probably is the only product in the building material which has gone down in price between 60 to 75%. And yet the industry has grown. There's been no inflationary pressure as far as consumer is concerned for tiles. So this is how tiles is. It's a volume game, and but it's largely a volume game. So to specifically answer your first question, I would let Sunit answer that. He has the figures.
Yeah, first, so just some clarity, I think I can sense that where the calculation you are referring to, and probably that is not the appropriate. So earlier we have been reporting the tiles volume performance segment-wise on a standalone basis, whereas now we graduated to consolidated basis reporting from this quarter onwards. And that's why I think you're comparing our last Q4 reported on a standalone basis versus this quarter reported on consolidated. If you look at the like-on-like basis, last year Q4 consolidated gross margin coming to 317 rupees, 317, versus 320 for this Q1. So it's a up of 3 rupees sequentially.
Okay. So second question is on the collection period. We have mentioned that our collection period has gone down by 5 days, but based on the data which is mentioned in your presentation, it indicates that our debtors period has gone up by 9 days, from 36 days in previous June quarter to 43 days in this June quarter, and it has been trending up for the past 4 consecutive quarters. So where do you see our collection period to settle over the next, say, 1 to 2 year period from here?
Oh, no. Again, I would say there is misleading in while reading the presentation out. So if you look at the debtors number which is given on our slide 6, it's clearly visible that it has gone down, absolute number of debtors, and you can easily calculate the DSO based on that number. So it has improved by 5 days. On March, it was standing at 48 days versus 43 days in June. And in absolute terms, I would say the 337 crore rupee debtor come down to 270.
No, sir, I'm saying on YOY basis, on a YOY basis, our revenue has been down. Last June quarter, our debtors was 231 crore, which has gone up to 275 crore. And because of that, our collection period has gone up.
Collection period, how do you calculate collection period? Or I think if it is slightly granular in discussion, we can connect offline, Akash.
Sure, sir. Sir, my last question is that for our Max plant, since we are operating at such low capacity utilization, we might be making very low margin from that plant. So just wanted to understand at what capacity utilization we can come to our company level EBITDA margin. That's one. And second, what is our ESOP expense booked for the June quarter?
So Max plant currently we are operating virtually very low capacity. It is around 35-37%, which is coming for this quarter, and it would ramp up gradually over next 2, 3, 4 quarters because it's a different product segment which we have plants have been putting, and it's a relatively a niche product segment, and it will improve. It will increase gradually over the period. So I believe difficult to comment any number, but I can give you a ballpark number. So I believe if the moment we reach to somewhere around 65-70% type of capacity utilization for this particular plant, I think this should give us a good break-even or level.
So this plant breaks even somewhere at the 60-65% level.
Okay. And so how much would be our ESOP expense amount?
We request you to please rejoin the queue for further questions.
Okay.
Thank you. The next question is from the line of Karan Batelia from Asian Market Securities. Please go ahead.
Hi, sir. Am I audible?
You are audible, sir. You may proceed.
Yeah. So just to continue on the Max plant, wanted to understand the average selling price, compared to the average selling price of 320 rupees at the company level for this quarter. How rich is the product profile at Max?
So the cheapest product at Max is about 50% higher than the average selling price of 320, and the most expensive product is double, a little more than double. But we are at 35% capacity utilization, so therefore, if you see the JV, most of the loss from the JV is only coming from one plant, which is Max. Everything else is reasonably profitable. So if you see last year, same quarter, all the other JVs were also ailing. So we did a lot of work to bring all of those JVs in profit. This we knew will be under stress for a couple of quarters because it's not a very easy plant to sell. So I hope I'm able to answer that question. That once again, 50% for the lower segment and about double for the higher segment.
Great. That was helpful. And secondly, on the capex front, now that majority of our capex has been done, how do we see next 2 years, capex shaping? Considering we are looking at double-digit growth, so what's the addition in the MSM that we're looking for?
So look, we're at 81% capacity utilization in tires, and we were at 89% capacity utilization in Q4. So we have very little headroom. So I think for the next 12 months to 18 months, we're okay. And after that, we would need some capex coming in. So obviously, we've started thinking about it, but there is no serious capex currently in the next 12 to 18 months in our plants.
Right. Thank you. Thanks, Abhishek. That's it from my end.
Thank you. The next question is from the line of Jyoti Gupta from Nirmal Bang. Please go ahead.
Sir, I want to know what's the mix of GVT, PVT, and ceramics, because apparently the competition, Kajaria, it seems they've increased the share of GVT, and that's why there's an improvement in their MSM. Where are we in terms of our product mix?
So yeah, I did mention it in my opening statement, but I'll repeat it for your reference. I am talking now YOY. Ceramic is currently this Q1FY25 is 35%. Last year, same quarter was 34%. PVT is 28%. I'm sorry. I want to repeat that. Q1FY25 ceramic is 35. The same quarter last year was 39. PVT is 28%. Last year was also same as 28%. GVT has improved to 37% from 33%. Now, having said that GVT keeps improving, now there is no rocket science to improve GVT because the whole market is moving towards GVT. So I would think that the GVT in the next couple of years is going to reach above 50% also.
And will that not also improve your realization on an MSM basis?
It's not only the realization we should be looking at, it's the contribution. So yes, GVT has more applications, so it would improve contribution, but just by saying that from 37 in the next couple of years it will go to 50+% doesn't mean that the realization will go up by the same amount, because GVT also has various segments. It has the low segment and the high segment, which I've said in the past also. So it's a little more complex than just being simply understood like, GVT goes up, so realization goes up. But GVT as a segment will keep growing. Worldwide, the entire market is moving towards GVT. In layman's terms, if I had to explain to you, it is moving from CRT TV to a flat TV. That is how it's moving. It's not that those TVs are not sold. So the old-fashioned flat TVs to the OLED TV. So that's how the technology is moving. Everything is going to move only a notch up and not a notch down because the technology of GVT is becoming more and more easy to adapt and also cheaper and cheaper going forward. So all of ceramic and PVT, not all, but a reasonable amount of ceramic and PVT, especially for the floor, will move to GVT. So happy to get on a call and explain to you a little further on this.
Sure. Thank you so much. I'll look forward to that.
Thank you. The next question is from the line of Bhavin Rupani from Investec. Please go ahead.
Hi, sir. I just had one question. What are your expectations on industry growth for the year, and do you expect our growth will be higher versus industry?
The industry growth in domestic should be a little bit. Last year we degrew, so there should be a little bit of growth considering that H2 onwards we will have a lot of these residential real estate started picking up and buying material. As far as export is concerned, clearly there will be a growth. Last year we did a 19,500 to 20,000 crore rupee export. I do believe that this should be slightly more than that. How much more than that will be really depending on the freight rates and the global scenario. It's not really only relying on the Indian dynamics. So at more than 65-70% capacity utilization, freight rate goes down. This should move up to from 1,700 crore rupees a month to at least 2,100 crore rupees a month because a lot of the traders are waiting for the freight rates to go down, which is record high as what I've given to understand right now.
And what will be our expectation versus industry growth? Will be higher or same?
So we've been always growing higher than industry growth, which is domestic industry. So that's clearly going to be the case even this year.
Is it possible to quantify by 5%?
I don't know how much industry will grow. I can quantify what I will grow at, but I can't quantify exactly how much industry will grow. There will be a percent. It will be definitely under 5% because a large part of the industry growth will come from export.
All right. Thank you so much.
Thank you. The next question is from the line of Vinamra Hirawat from JM. Please go ahead.
Hi, sir. I got a question on debt and debt reduction. In previous calls, we've guided, I think, for a debt reduction in term loans of 35 to 40 CR annually on a consolidated level. Are we still sticking to this?
Yeah, so that is annual repayment, Vinamra, which is anyways scheduled and that keep getting amortized over the period annually basis. That is what we told. And as far as debt level is concerned, it is the same debt level we have. So 335 crore rupee consolidated we had in March, gross debt, and the same level is there in June also.
Okay, got it. Thank you.
Thank you. We will now be taking the last question for this afternoon from the line of Utkarsh Nopani from BOB Caps. Please go ahead.
Yeah, so I just want the ESOP expression amount which has been booked for June quarter.
Yeah, Utkarsh. So it's a more of a national cost, but yes, what we have accounted for Q1 is 93 lakh rupee as a ESOP cost in our P&L.
Okay, thanks a lot, sir.
Thank you.
Thank you. That was the last question in queue. As there are no further questions, I would now like to hand the conference over to Mr. Somany for closing remarks. Over to you, sir.
Thank you so much, ladies and gentlemen, for joining us for the FY25 Q1 call. We hope for a better quarter and would welcome you for the FY25 Q2 call and the H1 call in probably next quarter. Thank you so much.
Thank you. On behalf of SKP Securities Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.